Hey Dion, so for those new to the property market, can you briefly explain what a mortgage broker does and how they differ from, say, a bank broker?
Yeah, for sure. Definitely, I think the key role of a mortgage broker is to act as that conduit between the bank and the client. So we're the independent third party. Um, and we act as the trusted advisor and relationship manager, right, between the client and the banks. We're there to guide the clients through the whole mortgage process. We provide unbiased, personalized advice that is bespoke to the client's individual circumstances. It's a little thing what we call best interest duties. So we've got to abide by that. You can't just refinance for the sake of refinance or do something for the sake of doing. We've got to find an actual reason for that. I think, the key differences between a bank and a broker, also, it's cliched, but we do really work wholly and solely with the client's best interests and for the client as the forefront of everything that we do. We work to secure the best possible mortgage terms for the client within what their requirements and objectives are. We also have access to over 40 to 50 different lenders with different policies and all these different options to actually ensure that, yes, it's the right fit that meet the requirements and objectives for the clients. And we also provide that really personalized and flexible service. And it's not a one-stop shop. We have an array of different ways we can get loans approved and meet more of the client's requirements and objectives.
Excellent. I mean, it obviously just instead of having two or three products that the bank has, you're giving our clients access to dozens of different products, which is excellent. Great.
Cool. I just don't think it's around the products, Julian. It's actually around policy, because a bank can. The banks literally just have the one policy that they have to fit a client into, whereas a broker has multiple different policies. The products are pretty similar across all the different institutions. So really, it's what are you looking to do, and where does it actually work the best and fit the requirements?
Excellent. So Dion, given the current economic climate, what are some of the mortgage trends you're seeing that prospective buyers should be aware of?
Yeah, look, I mean, apart from the elephant in the room, the rates are going up and potentially there's a talk of another rate rise at the next meeting. Can't verify that. I don't make the decisions. But what we're actually seeing is the banks changing a lot of policies, right, to make lending, I feel, easier and more accessible given the rising rates. Things like self-employed, especially around that self-employed space, where it is actually becoming easier for people who are self-employed to borrow money. Generally, if a client doesn't have great financials, they'd have to go to what we call an alternate documentation product, which generally have more fees and charges. They're generally higher, and we're finding that accountants aren't liking the idea of signing a letter, whereas some lenders now, if a client is a director of a company, they've been trading for about 2 years plus, but have been paying themselves a salary, a lot of the lenders will actually look at that going, okay, here's 6 months year-to-date salary, fantastic. We'll use that, it services, perfect. They're not taking into consideration any of the debts on the business, etc., because an accountant letter just says, they have the ability to pay this salary ongoing and the business is meeting its requirements and objectives, right? So it's actually getting easier for self-employed clients to lend, but it's only as easy as they've made it for themselves as well.
Well, that's right. We all often say build that team of experts around you, talk to your mortgage broker, talk to your accountant, and make sure you get yourself structured and well set up at the beginning. And then that's where the buyer's agent, if you choose to use one, can assist you in finding that right investment.
Yeah, 100%. And it's getting in early rather than halfway through the process. Let's start that journey at the beginning. Let's really understand, okay, you're self-employed. Okay, we're going to need to actually talk before you can go and find a property. Great deposit. Awesome. But where do we actually put you? How do we structure this? How do we structure your application? A lot of my clients, I would say about 90% of my clients are self-employed. So I see a vast majority, from the real simple sole trader to your company trust, and then multiple entity structures. So everyone, I just treat them all the same. It's cool, you're self-employed, let's get involved, let's talk to your accountant and really build relationships. And I think that's really the difference, again, going back to your first question, between a broker and a banker, right? We're here to build relationships over that long period of time. And then we go, here you go, Mr. Buyer's Agent, this is actually the real number, and we put a bit of contingency in place.
So Dion, why is getting a pre-approved for a mortgage crucial for buyers, especially in this current competitive market?
Yeah, look, we'll flick back to the second question. It's a good segue. If you are self-employed, there's a little bit few more hoops to jump through, right, to ensure that we can borrow. But is the mortgage pre-approval a necessity? Yes and no. It really depends on the situation and the complexity of the client. So if you've got a basic PAYG client, they've got a 20% plus cost or equity in their property, there's no issues on the credit file. As a broker, we've got this technology in place where, I can look at your credit file, you give me the authority to look at your credit file. We understand that you've got 20% plus costs. We can do a really quick funding table and run your income through a program called Quickly, and then it pulls up all the borrowing capacity. So really, if it was that scenario, I'm pretty confident. We do it a lot here, going, hey, we don't need a pre-approval based on what you've told me, unless there's some really nasty outliers. You're pretty confident for you to go and put an offer on a place, because what we're finding, especially at this time of year, if you want a pre-approval, well, the hierarchy of what gets approved first, you got purchases, refinances, and then you've got pre-approvals right at the bottom, because there's no urgency on the pre-approvals. Important versus urgent at this time of year is key for the banks making the decisions as to what it gets approved first. There are clear benefits, though, of getting a pre-approval. Obviously, it gives the buyers a clear budget and also strengthens the offer as well. If they're giving that information to the buyer's agent, well, the buyer's agent goes into it on a negotiating standpoint, going, okay, well, I know what number I can really go up to, but I don't want to go up there because I want to get the best deal, right? But it also speeds the home buying process up. So basically, if we've got a pre-approval in, the only outliers that we don't have is the security property and the valuation. And literally, that's all we're changing if we've already got a pre-approval in. So it does go quicker. But at the end of the day, there's lenders out there. I just had one last week. From submission to unconditional approval in under 24 hours.
Wow.
It is about, we had all the information there, just going, right, cool, find a property, bang. In the meantime, while they're finding a property, we're getting all that stuff ready, and it's all about the quality of submission. Yeah, we don't submit anything without the data.
It makes it a very, very smooth transition, particularly in the hot market where we want to grab a great deal. It's great to know that we've got that in the train, and we can be confident on satisfying the finance clause.
Yeah, 100%. I think it's also prudent to go through some of the cons of getting a pre-approval too, right? So every time we submit an application, it marks your credit file, right? If you're doing it with multiple banks, it's multiple marks on your credit file, can potentially lower your credit score, can cause issues later on down the track. So this is the importance of getting in early before we start that finding the properties and making offers, to understand the situation, what complexities do you have, and whether you actually need a pre-approval or not. Some pre-approvals, even though we submit it, are still not even fully credit assessed. You get a lot of banks that have got some really great technology that just approve just based on the numbers you've put in. Okay. The other thing is pre-approvals only have a 90-day expiry, and after that, with a lot of banks, if you don't find a property within that 90 days, we have to start the whole process again. You got to get all the data, all the documentation. We don't have the option of just updating with some of the banks. There are some banks you can just update and go, but yeah, those are some of the key points that I think you have to be aware of.
No, great. Thank you for that. And in terms of how would you best assist clients navigate the fluctuating interest rates? And what advice would you give someone trying to decide between, say, a fixed and a variable rate for their investment or home?
Yeah, that's a really good question. And it really comes down to what do you want the loan to do, and what is your actual strategy over the next 2 to 5 years, and what's really important to you in a home loan. Obviously, if they're looking at, look, I really want stability, and I really just want to know what my repayments are. Yeah, well, the fixed rate could be good, but you also need to be aware in this current market, the fixed rates are quite high in relativity, right? The variable rates are pretty much up there as the same, but the difference is the variable rates offer you flexibility to make more repayments. They've got the offsets that could potentially save you more money over a 2-3 year period than it could. But that's where the tailored advice and getting recommendations around aligning it to your goals, your requirements, objectives, and your risk tolerance to understand that piece. And again, that's coming in really early. If I had a crystal ball, probably wouldn't be working here. We'd probably be in a very different situation. But there are some good clients. We had a conversation 3 years ago, first home buyer, put them in a half fixed, half variable rate. He's come back to me three years later. He's found me. He's coming off his fixed of 2.19%, moving on to variable, but now he's buying a property, he wants to use the equity. He bought his property for 505. It just got valued in at 725, which is amazing. He's also then put a contract on a property. We didn't do a pre-approval for that, but we've kept it all as variable because it gives him the best options to pay loans down and has that better cash flow position for him. He's the client that we actually approved from submission to unconditional in 24 hours.
Yeah, no, great advice and great timelines as well to get that through. And in terms of what are some of the other often overlooked costs associated with securing a mortgage that some of the buyers should be prepared for?
Yeah, good question again. Some of these people already know about, but they're not accounted for in the funding table. So obviously bank fees, things like if you're refinancing especially, you're just not refinancing dollar for dollar. You do have to account for the discharge fee. Some of these discharge fees are anywhere from $350 to $500 per security, not per loan. It's usually per security. So if you've got 2 securities and it's $350 a pop, you're looking at $700 of cost there. But then also we've got to have contingencies for, accrued interest, right? I've had some clients actually stop making their repayments. I said, do not stop making your repayments. The bank will stop that usually for you a few days before, because you've got that obligation to do that. So there's that piece for the refinances there. You've also got the government to transfer of titles. So registration of discharge of mortgage, and then the registration of mortgage. So you're taking a bank off and putting a bank on usually incurs costs from the titles office. But in the sense of a purchase, so here are key things that people sometimes may overlook. Buyer's agent's fees. Number one, factoring it into the cost of the purchase price. So we've got a funding table, cost to purchase versus funds available. So I always put the buyer's agent's cost, again, working with the buyer's agent to go, hey, what's your actual fee? Like, what are we charging this client so I can actually make sure they're going to have enough cash to pay you, either before or at settlement. So putting that in, I've seen it, a lot of clients that have come to me after the fact have just gone, oh, I didn't know you had to pay that, or didn't know you had to account for that. I said, oh, who do you think's paying for it? Oh, I thought the bank would pay for it. It's like, no, it's a buyer's agent cost. Unless we can fit it into your lending, you will usually pay for that. And then we could maybe recoup later. So there's that, buyer's agent fees, solicitor's fees. I always count that. Had a great conversation with the solicitor last week going, you might need to probably up the solicitor's estimate from 1,500 to possibly 2,000 because we do a lot of different searches and that's giving us a bit of a buffer. So that's one thing I learned last week. So that's a change that the team's going to do. Build and pest inspections. Adding that, factor that into the loan cost on the left-hand side. Usually anywhere from $550 to $1,000, depending on the quality that you're getting, right? Got to account for that. And then having money set aside for insurances. Not so much for the funds to complete on settlement, but that's one thing you got to put aside. The other key thing that we don't know, and you wouldn't know, the only people that would know would be the solicitors, is around the variation in rates to water. right? I've actually had it in my 13 years of lending where the seller was actually $5,000 ahead on their rates. Don't ask me why, but no one knew till it came to settlement. And the clients had to find $5,000 circa to pay it because there was a variance. And no one knew about it. So it's always good to get in early and get that sort of figure early so you can budget. I normally would budget around about $1,000 to $2,000 of just variances there that you need to put aside just to have that contingency in place.
Excellent. I think the funding table, as you call it, or we call it, a cash flow analysis on every deal is so important to ensure everyone's clear and we're all sort of aiming at the same targets and the same numbers as we get towards settlement.
Yeah, and especially if you've got a few moving parts, like you've got a refinance, you're getting an equity out here, you've got another application for purchase. Well, how much do you actually need? You got to filter it back to the refinance. I need this much cash out. Right, cool. Is there enough equity in this property to do this full deal from here? And then you're kind of working everything backwards from there and just making sure that everyone's on board to maximize, especially with investment, maximize the taxation.
Exactly. So Dion, how significant is a buyer's credit score in the mortgage process, and what steps can they take to just in case their score isn't where they'd like it to be?
Yeah, good question. And I think that's a few different moving parts which we can go through. So it is literally, I feel, the number one thing, right? Because regardless of how much income you earn, regardless of how much deposit you've got, most banks, and I would say the majority of the banks that most brokers would use, have a credit scoring system in the background. Okay, this credit scoring system looks at your conduct over the last 2 years on your loans, credit cards, personal loans. It also looks at what directorships you've got, whether you've been bankrupt, whether you have got any any of your companies are under administration. It looks at, it's a very comprehensive credit report, i.e. that's why it's called there's comprehensive credit scoring on there. So that's one thing. And we actually look at that right up front. So when we send out our client portal, there's a credit guide and a privacy guide in there as well, which allows us to look at the credit file. And when we go and have, I've had it in the past where I haven't even done a face-to-face meeting. We've just paused and I've just rung the clients and just gone, hey, tell me a little bit about your credit file. Why has it got here? Because there are ways to mitigate it, but it just limits the lenders that you can use. So a couple of key things that you can do to improve your credit score is around, don't make too many applications for credit. It seems really simple, right? But it's one of the things that actually lowers your credit score, especially if you're just making applications for unsecured debt. I feel that's so personal loans, credit cards of the sorts where it actually has more of an impact. Also doing pre-approvals with multiple different banks. Why are you doing that? A broker would never do that. If you're going by yourself to multiple, shouldn't say a broker would never do that, but they shouldn't be doing that because really you've got a list of who you'd go to. That's one key thing. Making your repayments on time and not missing payments and not being overdrawn on any accounts and things like that is really key right now because we're going to be soon going into what's called open banking, where transparent, every bank and financial institution will potentially know your history and story. So there's nothing, you can't hide anything basically. And what that means is the banks are going to be able to make the best decisions for that client and what sort of loans they get, if any. Right? Now, if you have had issues in the past, right, how can you rectify that? You can't rectify everything, right? No. There's certain things that you're just going to have to cop on the chin. But I've seen clients with a overdue amount, outstanding amount for Origin energy bill. Let's call it energy bill. But there's extenuating circumstances where they've left a property, gone to another one, haven't gone back to that said energy provider, and they've marked the credit file as unpaid. Now, seems harsh, but look, it is your responsibility at the end of the day to make sure that they're paid. There's no two ways about it. But if you've actually done that and let them know that you've moved and things like that, and they still haven't sent it to the right place, or there's other extenuating circumstances, there are credit repair agencies that can actually go into bat for you and rectify that and actually remove it from your credit file. We've actually had that removed from a client's credit file. It was a difference between them getting a property and them not. Them getting a property based or them getting a loan with what we call subprime rates, sitting at anywhere between 8 or 9%, or getting them with normal residential rates sitting at that 5.5%, 6% back in the day. And the only key to that though, it takes time. It's not just hey, we're just going to click our fingers and we're going to magically make it disappear. The process is about 30 business days, usually, depending on the complexity. So again, this is the importance of getting in early, seeing the credit file. Can you do this now, or do we need 30 days?
Yeah, absolutely right. What we said at the beginning about building your team of experts at the beginning of the process, so you can move smoothly through the entire buying cycle.
100%. It's building that dream team, right?
Exactly right. Exactly. Excellent. Thank you for that. There's also a lot of debate about how much should one put down for the payment, the initial deposit on a property. What's your perspective on this, and how does that impact the mortgage terms?
Yeah, definitely. Look, the deposit can come from very various causes. So it really depends on what you're trying to do. So if it's a investment, we want to maximize the lending against the investment, ideally, and we would get that guidance mainly from an accountant. Right? Hey, look, what's the actual tax strategy here? Is this okay to do? It is a lot of collaboration and that relationship that we do have with accountants that allow us to actually make sure our loan structure is set up for an investment purpose. So for an investment, we usually like to maximize the lending. Now, we can do this in different ways. So if the client's got an owner-occupied property and there's equity in the property, what we could do is take an equity loan. We usually would only go up to probably 80%. Sometimes we'd go up to 90%, depending on where it is, because once we go over 80%, we're in lender's mortgage insurance territory. The rules change a bit, the rates go up. So ideally, we like to do what's called a 80-20 structure. So buying an investment property, standalone security. I personally do not like to cross securities if we can avoid it. It has a few exposure problems there. And I can't just take that one property and put it in a different place if it suits. So purchase property, let's say it's 500,000. It's an investment. We'd go 80% against the investment. Fantastic. That's 400,000. We would get the 100,000 plus costs if they've got an existing property using the equity in the property. What that does, it actually maximizes the tax deductibility potentially for that property, because we've borrowed the full amount plus costs. Now, again, get the advice from your accountant as to what's tax deductible or not. But if that money is being used for the purpose of purchasing an investment property, then it would be safe to assume that that's tax deductible as well. If clients have 100,000 in cash and we're going to put that money in towards an investment, we could use what's called a debt recycling strategy as well, and that would be case by case. Make it like that 100,000. Once you put it in, well, that's not tax deductible. That's right. Why would we put that in there? We could potentially lower your owner occupied debt down because that's not tax deductible. Take that money back out as an investment debt, make it tax deductible. It's being used for the same purpose, but now you've got a lower repayment on your owner occupied, which is not tax deductible. Right, and we sort of increase that cash flow, artificially increase that cash flow for you potentially as well.
Such simple ideas and tips, but the simple ones that people don't pick up unless you're a very good broker, no. Which obviously you're able to pick up, and also build the right strategy for each individual client of yours as well.
100%. It is about the right strategy for the right client. We've had some clients that don't have massive deposits. We've had to go 90% against the investment property and get the 10% plus costs outside, which is either done through the equity, because that piece there. Again, case by case, we'd run the numbers. Is it the best fit? Is it not? Do we need to wait? Can we get cash elsewhere? For an owner occupied, it is very different, right? We want to put as much deposit as we can into an owner-occupied. Ideally 20%, but there are, if you're a first home buyer, you almost only have to put 5% plus any cost down, and you actually can potentially get your LMI waived. Again, there are so many terms and conditions on it. It is really important that you do see a finance specialist like myself or my team at Emerge that has the expertise in that to be able to guide you, because it isn't for everyone. So yes, there's a lot of complexities because it's run by the government.
For those home buyers or those re-entering the market after a long hiatus, what's the one piece of advice you'd give to ensure that they secure the best possible mortgage for their needs?
I think it's a two-pronged approach. There's probably two bits of advice that I'd give you. Firstly, get a team behind you that's there to help you and not themselves. So that is, obviously, you got that professional guidance, obviously consulting with a finance expert like myself, or whoever that you've got that you trust in that sense to guide you through the finance process, but also working with a buyer's agent like Search Party Properties, right, that have that knowledge, have that expertise, and will guide you through the process, because it is quite daunting. Regardless of how many times you've bought a property, there's still that, oh my gosh, you've got that anxiety in there. So the people like myself and like your company as well, reduce that anxiety, reduce the stress. Also, because there are so many moving parts, let the experts do the work. Right, that's what they're there for. So, yep, dream team, seek that professional guidance. And the second piece of advice is educate yourself. Right, there is so much information out there right now, good and bad, and it's just there definitely is. And just understand the process, understand what's out there. And then once you understand that really high level, when you go back to your team of professionals and you're seeking that guidance, you can ask those questions around, oh, hey, have you thought, I was looking at this, what are your thoughts? And be really collaborative about it, because at the end of the day, your team is there to look after you and just go, yeah, great idea, let me put that into my thoughts. Or, hey, look, that's a really good point, but in your situation, it doesn't really fit, X, Y, Z, what reasons why. So those are the two bits. Get a dream team, so get those professional services behind you, and educate yourself.
Great points. And I think education is the key, and in our business, we're educating our community every single day through LinkedIn, through Facebook, through YouTube. And, there's so many places to get education for free now, as opposed to when we were coming through as investors, you had to go to seminars, which are run by Spruikers really back in the day. So you didn't have the books and the YouTube and the Facebooks and the groups that you can belong to actually who want to help. Some groups are probably slanted towards their own agenda, but most groups are pretty friendly and pretty open to assisting you with your needs and your questions.
Yeah, 100%. We've got Luke, who is one of the brokers here. He started, his niche is really first-home buyers, and he started this Facebook group for first-home buyers in Brisbane. Amazing little group. He hasn't got that many followers. It's probably 50, 60 followers, but he's got a lot of experts in that group. So I've actually seen some of the content, well, not really the content, but the conversations that are happening. It's great, because that's how people are actually educating themselves, and the experts are there to help.
Excellent. I mean, I'm sure that group will grow now with the new incentives in Queensland as well. So that's wonderful.
100%.
So, thanks again for your time, Dion. Appreciate it.
No, I really appreciate the time that you give me, and hopefully we'll be able to help and educate more people. And
just finally, just let our community know where can we find you?
Yeah, so I'm at Emerge Finance. We are a finance specialist that specialise in residential investment, development finance now as well, commercial asset finance, located in Brisbane. But I see clients everywhere, all around Australia. We are really good at what we do. I'm sure you hear that from everyone, but we really do take the time to sit down and understand what your requirements and objectives are, and be real with you.